Ladies and gentlemen, boys and girls, welcome to the show. I am your host with the most, Chase Money. Yes, my last name is Money, and what a day, what a week, what a year it has been. And 0 days without a tariff headline. Donald Trump back in the news, kicking Monday off with a bang. And we're going to talk about everything that happened in the market. What were the big winners? Oh, I should say, what were the biggest losers out of all of the losers? We're going to talk about the Magnificent Seven, previous drawdowns, what JP Morgan thinks about the earnings picture, the history of the trade war so far. We're going to look at UBS's take for the market. Are they bullish or are they bearish? And some bearish things going on with regards to AI, Amazon, Nvidia, some mergers and acquisitions, and Donald Trump as well. But before we dive in, could you please go ahead, like this video, subscribe. It really helps a page and a channel like this out. Let's dive in. Now, let's quickly do a recap of the market. Very red day. The S&P 500 down just shy of 3%. We saw selling every day. Today was literally a liquidation day, guys. When you see stuff like healthcare sell off down 2.42%, when you see stuff like utilities down 1.5%, these are defensive sectors. You know it's a very ugly day. And you see here the S&P 500 was down 2.4% today, so not 3%, sorry, 2.4%. The NASDAQ 100 was down 2.6%, the Dow Jones 2.5%. In the context of what most of these indices being down double digits for the year, with the NASDAQ 100 being down 17%. And at one point, the S&P 500 as well as the NASDAQ 100 was within bear market territory, and that is a pullback of 20% or more. And all of the selling has been led by the Magnificent Seven. You can see every single Magnificent Seven name: Microsoft, Apple, Google, Amazon, Meta, Nvidia, and Tesla, which reports tomorrow, by the way, are all in bear market territory. Again, a pullback from the highs of 20% or more. Tesla leading the downside here, being in a 50% pullback. Brutal. Nvidia actually in second last place, down 37%, followed by Meta. You can see the best performer here being Microsoft, which I guess is less exposed to the consumer. You can see Tesla most exposed to the consumer, and that is why we're seeing the market pull back. Also, a lot of these companies had incredibly rich valuations coming into the year, and when we do get a softening of demand, a softening of the consumer, a softening of the economy, these stocks are going to take it on the chin. And guys, when we have a look at a major drawdown, so this was the biggest drawdown the market has ever experienced apart from what we saw in the 1930s during the Great Depression, you can see that we actually do have a lot of what we call bear market rallies. So peak to trough, S&P 500 fell 57% here from 2007 to 2009. So this was late 07, mid 07 here from April. We sort of peaked out late 2007, right? And then we made a bottom here, April 2009. During this entire time period, we had three rallies that were double digits, from the lows. Here 11%, here 12%, here 24%. But then we actually kept moving lower, and we actually had 1, 2, 3, 4, 5 individual rallies that were greater than 5% in this time period. So the move we've seen in the S&P 500, this bear market rally, they tend to happen. And if we don't go ahead and actually make a higher high like we did right here, we tend to continue to see movement to the downside. And that's exactly what happened in the S&P 500 right now. Yes, we did make a strong move off the lows, but we were unable to break above these highs. And that does normally signal a more downside. But again, you do have to look at other factors apart from the technicals. You do have to look at the macro. You do have to look at the fundamentals, and you do have to look at Donald Trump, because ultimately that is going to impact the overall policy. And JP Morgan right here, this is their thought of the week as to where the S&P 500 is right now. And I'm not going to read you this whole thing. I'm going to break it down. And currently, they say, looking at consensus EPS projections for the first quarter 2025 and full year 2025, they're expecting EPS growth of 7.1% and 10% respectively. However, they say those estimates are based on economic assumptions that no longer hold. Tariffs will slow growth, increase inflation, and undermine confidence. Weaker demand will hurt revenues. Higher costs will hurt margins, and reduced profitability will hurt buybacks. Even if this administration changes its mind, the longer uncertainty remains, the longer spending will slump. and the greater the hit to growth. This is from JP Morgan Chase right here. So they're saying that these economic assumptions that we have right now aren't actually baking in a tariff impact, and we can actually see earnings estimates go lower unless something changes in the very near term. And this all stemmed from the trade war we have between what is the US and the world, but ultimately the US and China. And we're going to break down the events right here. So February 1st, days after taking office, Trump imposes a new 10% tariff on all Chinese imports. That's on top of existing tariffs from its first term. Very interesting. February 4th, China retaliates with a 15% tariff on US coal and liquefied natural gas, and a 10% tariff on crude oil and agricultural machinery and large cars. March 3rd, Trump raises the US tariff on Chinese imports another 10%, cumulative new tariff of 20%. March 4th, so China reacting immediately, China counters with a 15% tariff on US chicken, wheat, corn, and cotton, and a 10% on sorghum, soybeans, pork, beef, aquatic products. That's very, very weird. Aquatic products, fruit, vegetables, and dairy products. April 2nd, this is literally a tit for tat trade war. As a part of his Liberation Day agenda, Trump raises China tariffs another 34%, cumulative new tariff 54%. And this is where things took a turn for the worst. It was after the Liberation Day shenanigans. On the April 4th, China responds with an additional 34% tariff on all US goods, effective April 10th. Then Trump retaliates against China's retaliation by imposing another 50% tariff. Can you believe that? Cumulative new tariff 104%. We are waiting for their quote call, Trump says on April 8th, suggesting he's willing to negotiate with China. April 9th, China vows countermeasures, escalates as China increases its tariff to 84% on US goods, and Trump's 104% duties officially take effect. So the Liberation Day tariffs went into effect. April 9th, President Trump announces a 90-day pause. This is when the S&P 500 ripped up 10% in a single day. Trump announces a 90-day pause on tariffs for any trading partners while raising tariffs to Chinese imports to 145%. And April 11th, China increases its retaliatory tariff on US to 125%. And then April 11th, the US announces reciprocal tariffs will exclude consumer electronics from tariffs from most countries, but retains a 20% tariffs on electronics from China. So, we escalated all the way up to April 11th, and then we started to see de-escalation right here. But, we went tit for tat. It was a lot to cover. We covered it all on the main channel, so go ahead, subscribe to me on the main channel. But yeah, this is essentially what JP Morgan believe is going to weaken the economy. The flow-on effects of tariffs aren't baked into estimates. JP Morgan believe ultimately we could see EPS come down, and that's going to capitulate multiples if that happen. However, UBS are a little bit more bullish. They say tech stocks have come under renewed pressure as US expands its chip export curbs while tariff uncertainty remains elevated. But while volatility is likely to remain in the near term, we think solid fundamentals of the AI growth story will drive the sector's long-term outperformance. The strategist added that he expects global tech earnings to grow by the low teens in 2025, while AI adoption rates could cross 10% by year end. And he quotes, "While downside risks do remain, we believe the risk of a more severe economic downturn is now more limited," and he sees US equities as attractive regarding everything and the de-escalation you've seen in the trade war. Adding onto this with UBS and their take on AI. However, there could be some cold water poured on this because we are getting some news here. This is an equity research from, I believe, Goldman Sachs, and they said AWS goes pause on data centers. So pretty much their call. Industry sources have pointed to a pause in new COLO deals for AWS. It is not clear how widespread the pause is at this point, but points to some moderating hyperscale leasing in the near term for the two largest hyperscalers, Microsoft and AWS. And that could throw a little bit of cold water on this AI adoption story. And we do know that AI and the AI story has gotten hit quite significantly. US with US chip controls. CNBC came out and said this is actually going to benefit China because that has effectively taken Nvidia out of the market. And essentially what the US has done is instead of fostering competition, they've removed probably the biggest and most competitive player from the Chinese market. And that means number two competitor, Huawei, is now going to step in. And Huawei did actually come out today. They released, I believe, their 910C chip that competes with the H100, even though that is 2 generations behind Nvidia. It's still quite surreal to think that there is actually a competitor that's not in the US that can actually compete or has a chip similar to the H100. So look, a lot of the China policies and a lot of these chip control policies from this Trump administration, also from the Biden administration, are going to have flow-on effects onto the market, onto global competition, but we'll see how it pans out. And long story short, I don't think we're going to see significant revenues from NVIDIA with regards to China in the near term. Now, guys, looking at some mergers and acquisitions, we thought for the year, and Capital One and Discover have officially merged, making it the 6th largest national US bank. The combined bank is expected to have consolidated assets of approximately $637 billion, making it the 6th largest nationally. And this comes after regulators approved Capital One's $35 billion purchase of Discover. And some people even suggest that this would make the new entity the biggest credit card issuer in the US by loan volume, even bigger than JP Morgan Chase. And lastly, guys, before we wrap things up, President Trump again called on Jerome Powell to cut interest rates even after threatening to oust the federal chairman last week. He wants Jerome Powell to cut rates right now. He called Jerome Powell a loser. He called him way too late. And I believe what Donald Trump is doing here is posturing to put all of the blame of economic weakness onto Jerome Powell for not cutting rates. Nonetheless, I do believe the Fed should maintain their independence. I think Trump is in the wrong here for doing this. He shouldn't attack the Federal Reserve. If you look at a country like Turkey, where the Fed and the US government are not independent for each other, you generally have a higher unemployment rate and you have higher inflation as well. And you don't really want that. You want the Fed to be independent so that they can make decisions independently of what the government is doing without any pressure. I think they operate far better in that situation. Donald Trump obviously has an agenda, and as time goes on, we'll figure out what it is. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.